Did you know that Sir Isaac Newton was a stock investor? Back in 1720, Isaac Newton invested in one of the hottest companies in England, South Sea Company, and as his money doubled in value, he sold his shares. But just a few months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost an equivalent of $3 million today. Which begs the question, what does it mean to be an intelligent investor? According to Benjamin Graham, being an intelligent investor is not about having a high IQ or SAT scores. Isaac Newton was one of the smartest people to ever live. Yet, by Graham's standards, Newton was far from an intelligent investor. An intelligent investor, as Graham describes it, means being patient, disciplined, and being eager to learn. Quote, "We have seen a lot more money made and kept by ordinary people who were emotionally suited for the investment world than even those with extensive knowledge of finance, accounting, and stock market lore." So today, let's go over the main ideas from one of the greatest books about investing ever created, at least according to Warren Buffett, The Intelligent Investor. Idea number 1. Meet Mr. Market. Imagine having a neighbor called Mr. Market. Every day, he gives you his opinion on what he thinks your stocks are worth, and he offers you to buy your stock or sell you additional shares. The problem is, Mr. Market isn't always right, and oftentimes he is very wrong. For example, one day Mr. Market comes out in a panic. He says, "Oh my god, your stock is worth 10% of what it was worth 2 years ago. You are losing money." You get concerned, but then you realize that the company you own stock in grew its customer base by 30%, sales grew over 59%, and gross profit grew by 126%, all in a single year. So, should you let this crazy neighbor decide what your stock should be worth? Well, no. This example, by the way, was Amazon in the early 2000s, where it lost 90% of its value. One of Graham's biggest principles is that a stock isn't just a paper with a symbol and a price tag. A stock is a piece of ownership in an actual business. And since the market isn't always right, the price of a share doesn't always equal the value of the business. Graham says that the market is like a pendulum that is perpetually swinging between optimism when prices go up and pessimism when prices go down. This is where the strength of your emotional endurance is tested. Graham says to invest if you are comfortable holding your stocks without worrying about Mr. Market's crazy mood swings. Now, Mr. Market doesn't force you to buy or sell at any particular time. It just presents you with the opportunity for you to do business with him. This gives you the opportunity to take advantage of Mr. Market's mood swings if you choose to. You could sell stock if you think Mr. Market is getting too optimistic and prices are getting too high. Or you could buy stock if Mr. Market is becoming too pessimistic and prices are getting low. As Graham says, I like to buy from the pessimist and sell to the optimist. Or you can just hold your stock and let Mr. Market have his moment. Idea number 2. Becoming a defensive investor. There are 2 types of investors Graham mentions in the book: the enterprising or active investor and the defensive or passive investor. The enterprising investor continuously searches, selects, and monitors a mix of stocks, bonds, and mutual funds. He might have the opportunity, but not the guarantee of a higher than average return, but with a much higher risk of loss. The defensive investor doesn't really want to deal with the nuances of the market, so instead of carefully and consistently monitoring financial securities, he creates a permanent portfolio that runs on autopilot and requires little to no effort to run, although this option isn't the most exciting since it has small but steady returns. Graham advises that the majority of people are best suited to be defensive investors, since most people have limited time to closely study the market. The defensive investor, according to Graham, must have a combination of high-grade bonds and a diversified list of leading stocks. This will allow the investor to profit from the growth of the market while creating a defense system against the mood swings of Mr. Market. For example, let's say that we have a simple 60-40 split in our portfolio, made out of 60% stocks and 40% bonds. All we would have to do is rebalance our portfolio once or twice per year. If at the end of the year our stocks grew in value, this means that our ratio also changed, and now we have 70% stocks and 30% bonds. So we sell stock and use the money to buy bonds to get back to our 60-40 split. This allows us to safeguard our profits by putting them in safer bonds. Similarly, if the stock market didn't do well and put our portfolio in a 50-50 split, we can sell bonds to buy undervalued stock to get us back to our 60-40 split. This allows us to take advantage of an undervalued market by moving money from bonds to better priced stock. Of course, your ratios might be different depending on your goals and the return of both stocks and bonds. Although Graham recommends never allocating more than 75% of your money in stocks, but also never going under 25%, with a remainder of your portfolio in high-grade bonds. Investing a fixed amount of money at regular intervals, like right after you get your paycheck, is what is called dollar cost averaging. This will help you get a fair price on stocks and bonds regardless of what Mr. Market is doing. This will help you ensure that you don't invest all your money at the wrong time, which can be costly. And this way, you can take advantage of both bull markets and bear markets. Idea number 3. Finding the right companies. Benjamin Graham has a few guidelines for defensive investors to find the right companies to invest in. Number 1. Diversification of the companies you invest in. Graham says investing in 10 to 30 companies should be enough. Make sure you are not overexposed to one industry, so invest in stocks in a variety of industries to reduce risk. Number 2. Invest in large companies. Graham considers companies to be large if they have over $100 million in revenue yearly. Adjusted for inflation, that would be around $700 million per year. Number 3. Find conservatively financed companies. In other words, you don't want a company with too much debt. Graham suggests that you should aim for companies that have twice as many assets as they do debt. Number 4. No earnings deficits in the last 10 years. Number 5. The company has consistently distributed dividends for at least the last 20 years. Number 6. At least 33% growth in the last 10 years, which is around 2.9% per year. Although the current version of the book recommends at least 4% yearly or 50% over 10 years. Number 7. Don't overpay for earnings. The PE ratio should not be more than 15 times the average earnings of the last 3 years. And number 8. Don't overpay for the stock. The price of the stock should not be more than 1.5 times the net asset value of the company. This can be calculated by taking their assets and subtracting their liabilities, like debt and preferred stock. Graham emphasizes that the money is made on the buy, so never overpay for stock. If you want to learn what the PE ratio is and how to calculate it, make sure to check out our video on the 10 things you must know about the stock market, which you can click on at the end of this video. It is important to understand what makes a company a good investment. But today, the defensive investor does not need to analyze and pick individual stocks anymore. It isn't even advisable. With the creation of index funds, investors can own the entirety of the stock market with one investment. Picking stocks is like trying to find a needle in a haystack. But defensive investors can avoid looking for the needle, but instead own the whole haystack. Number 4. Protect yourself against inflation. Something that investors tend to overlook is inflation. One of the reasons is what psychologists call the money illusion. For example, if you receive a 2% raise in a year when inflation runs at 4%, you might feel better than taking a 2% pay cut in a year when inflation is 0. Yet, both scenarios leave you in an identical position since both leave you with 2% less value. Similarly, investors must take into account not just their absolute return on investment, but their real return after inflation. Looking at historical data, stocks have outpaced inflation a good 78% of the time, making it a pretty good investment for inflation. But it isn't perfect. When inflation is fairly low, businesses are able to pass down their rising costs to consumers fairly easy. But once inflation gets high and runs over 6% per year, historically, stocks no longer do well, since high inflation forces consumers to cut costs and spend less, causing the entire economy to underperform. The book recommends 2 main assets to protect yourself against inflation. Number 1, REITs, or real estate investment trusts. These are companies that own and collect rents from commercial and residential real estate and become real estate mutual funds for investors to buy. And number 2, TIPS, or Treasury Inflation Protected Securities. These are U.S. government bonds that automatically go up in value when inflation increases. Now, the value increase of these assets are technically considered to be taxable income, so TIPS are best suited for tax-advantaged retirement accounts like a 401k or an IRA. Now, if you're looking to be a passive investor, these main 4 points will get you there. But if you're looking for more, then number 5, becoming an enterprising investor. Why do you think brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the stock market did that day? Because whenever you trade, they make money, whether you do or not. Being an active investor does not mean being a trader. As Graham says, being a stock trader is the fastest way to a financial disaster. Traders make their money based on speculation. The difference between an investor and a speculator is found in their attitude towards stock market movements. The speculator tries to anticipate and profit from market fluctuations, while an investor focuses on using these fluctuations to acquire securities at good prices. To an enterprising investor, market fluctuations are only important in a practical sense. When prices get too low compared to their company's earnings, it might provide an opportunity to buy and hold additional shares. When prices go too high, it could be an opportunity to either hold and expect prices to come down, or sell and buy back once prices become suitable again. In other words, a speculator prioritizes price over value, and an investor prioritizes value over price. Since active investing inherently carries more risk, Graham recommends enterprising investors to start with a defensive foundation, just like passive investors would, to protect against the added risk. Graham also warns that enterprising investors must have a vast knowledge of market analysis before embracing this journey, and that being an active investor requires a higher level of emotional endurance in order to do it successfully, since even professional investors get it wrong more often than not. This is why Graham insists that enterprising investors apply what is called margins of safety. This means acquiring assets that are priced at 2/3 the intrinsic value of the business, after doing thorough research on the business. This allows for a 33% margin of error, meaning the investor gives himself a chance to be wrong and still be profitable. Establishing a margin of safety does not guarantee profits, but it allows for a higher chance for profit than for loss. These undervalued assets are not easy to find and are most common in market crashes and recessions when stocks tend to be undervalued. Graham talks about strong businesses that fell out of popularity as good opportunities to find undervalued businesses. Graham's most successful student, Warren Buffett, has used Graham's teachings to build one of the biggest and most successful investment track records in history. Buffett looks for strong brands with healthy financials that are becoming unpopular, either after a scandal, a loss, or a market crash, once companies become attractively priced. For example, Warren Buffett made billions of dollars due to a salad oil scandal. In 1963, American Express was in the midst of a scandal with a company overseas. Amex had loaned this company a large amount of money and had salad oil as collateral. After realizing that this collateral didn't actually exist, American Express stock fell over 50% overnight. Warren Buffett said that the underlying business was still sound, and he used this opportunity to buy 5% of this company for $20 million. Since the underlying business was still great, the company recovered. Warren Buffett sold some of his stock a few years later to allow for diversification, but to this day, he still holds much of this original purchase from the 1960s, worth billions of dollars. In the end, investing is not about beating the market or finding that one stock that will go to the moon, but instead, the whole point of investing is to generate enough money to meet your needs and create financial freedom. Like the book says, it's not about beating other people to the finish line, but rather crossing the finish line yourself. Now, this book is packed with information, so I highly recommend you give it a read. Let me know in the comments which one idea from this video resonated with you the most, and why. You can also check out this video on the 10 things you need to know about the stock market that we referenced on this video. And as always, thank you for watching, and I will see you in the next video.